Are you new to investing or wondered how investment taxes work in Canada? Most Canadians have investments in one form or the other, such as stocks, ETFs, mutual funds, real estate, or GICs. But a large percentage of Canadians don't fully understand how investment taxes work, which ends up with them paying more taxes than they should. So here are the top 5 things you should know based on the frequently asked questions my clients ask me over the years. And I'm gonna explain to you how investment taxes work in Canada from a very basic overview as if you knew nothing but want to get into investing. Number 1 is, will I get taxed if I hold an investment but don't sell it? The simple answer is no. Let's say you bought a stock or ETF or mutual fund for $10,000 and it went up to $12,000 and you continue to hold it because you believe it will go up in value. Because you haven't sold the investment yet, this $2,000 gain is what we call an unrealized gain because you actually haven't cashed in the profit by selling the investment. On the flip side, let's say you decide to sell it now, then you would have what we call a realized gain, and this will trigger taxes. But this does get a little trickier when you invest in a non-registered account. A non-registered account is basically any account that is not a registered account, such as RSP or the Registered Retirement Savings Plan, TFSA, Tax-Free Savings Account, FHSA, First Home Savings Account, and RESP or the Registered Education Savings Plan. The most common example of a non-registered account is your regular checking or savings account from your bank. Have you noticed you usually receive a T5 tax form from your bank around February or March? This is because with non-registered accounts, when you receive dividends or interest income, it will trigger taxes in the year that they're received. So this is one scenario where you will get hit with taxes even if you don't sell an investment. Number 2 is, will I get taxed if I sold an investment at a gain but didn't withdraw it out of my investment account? The answer is it depends on the type of account that you're holding your investments in. If it is a non-registered account, then the answer is yes, you will get taxed. But if it's inside a registered account, then the answer is no. Let me explain. With non-registered accounts, taxes are triggered in the year you sell an investment. In the case here, the government doesn't care whether or not you move money in or out of the account. They just want to know when you sold the investment and did you sell it at a gain or loss? So when you sell an investment in a non-registered account, then yes, you will get taxed even if you did not withdraw any money out of the account. But if the investments are held inside a registered account, then the answer is no. Here it works the exact opposite, where the government doesn't care when you sold the investment or whether you sold it at a gain or a loss. They only care when you withdrew the money out of the account and how much you withdrew. This is often why we hear the fancy term tax deferred, because investments can grow tax-free as long as they remain inside the registered account. Basically, the taxes are deferred, or in other words, they're paid later when you decide to withdraw the money out of the account. But there are some exceptions to this rule. The first exception is with the TFSA. The TFSA is tax-free, as the name suggests, so withdrawal for any purpose at any time is not going to trigger any taxes. The second exception is the first home purchase. When you purchase your first home, you're allowed to withdraw up to $60,000 from your RSP or any amount from your FHSA tax-free. But with the RSP's Home Buyers Plan withdrawal, there is a catch where you would need to repay the money within 15 years. Starting in the 5th year after you made the withdrawal. The limit used to be $35,000, but it got bumped to $60,000 in 2024. So how do you make a home buyer's plan repayment then? It's actually fairly simple. You just contribute into your RSP as usual, and if you choose not to repay in any given year, then the minimum amount will be added onto your total taxable income. So you'll end up paying more taxes. So with this in mind, FHSA is clearly the better option here because it has no strings attached after the withdrawal. And the third exception is schooling. When you study full-time in an eligible post-secondary program, you can withdraw up to $20,000 from your RSP tax-free. Similar to the RSP Home Buyers Plan, you do need to repay the $20,000 as well. And the repayment period for this lifelong learning plan withdrawal is 10 years, and repayment starts in the 2nd year after your first withdrawal. Also, when it comes to RESP, you can withdraw your contributions tax-free at any time as well. That being said, if you withdraw the contributions for non-educational purposes, then you'll need to return the grants back to the government. Number 3, how much taxes will I pay? Did you know that the regular savings account, or GICs, actually get the least favorable tax treatment compared to other types of investments? When it comes to non-registered accounts, the tax treatment is different depending on what type of investment income you receive. For the average investor, you're going to run into 4 types of investment income. There's interest income, capital gains, Canadian dividends, and foreign income. Now, an example of where you would typically receive interest income is your regular savings account, or GICs. And with interest income, the amount you receive is 100% taxable, which means whatever amount you receive in interest, it will be added onto your total taxable income and be taxed at your highest marginal tax rate. Next is capital gains. An example of this is when you sell a stock or ETF or a mutual fund, and the tax treatment is 50%, meaning if you made a profit of $10,000 from selling a stock, then 50% of that, or $5,000, will be added onto your total taxable income, and of course be taxed at your highest marginal tax rate. Also, if you have more than $250K of capital gains within a calendar year, then any amount above $250K will be taxed at a rate of 67%. Next is Canadian dividends. An example of where you might get this is if you hold Canadian stocks or an ETF or mutual fund that has Canadian holdings. The tax treatment for this is a little bit more complicated because it involves getting a dividend tax credit. And there is a difference between an eligible dividend versus a non-eligible dividend. You pay less taxes when it comes to an eligible dividend, and for the average investor, just know that when you're investing in a large Canadian corporation, the dividends you receive are most likely eligible, which means you are getting a more favorable tax treatment. Now, for the average Canadian dividends are actually the most favorable because you will be paying a lower tax rate compared to capital gains as long as your income is less than 177K in BC, or if you're in Ontario, if your income is less than 114K. Finally, there's foreign income. And where you would get this is when you hold foreign stocks or ETFs or mutual funds that have foreign companies. All interest or dividend income from foreign stocks are considered foreign income. And the tax treatment for this type of income is 100% taxable. Finally, to give you a sense of the actual dollar amount of taxes you would pay, let's assume you made $10,000 from each investment type, so we can compare the different tax amounts. For someone with an 80K income in BC, you're in the 28.2% marginal tax rate. So for 10K of interest income, you'll pay $2,820 in taxes. And if you had 10K of capital gains, then the tax will be $1,410. If you had 10K of eligible Canadian dividends, you'll only pay $163. Finally, for 10K of foreign income, you'll also be taxed at $2,820. This is how the investment taxes work when it comes to non-registered accounts. Now, what about RSPs then? For RSPs, any withdrawals aside from the home buyers plan or the lifelong learning plan will be added onto your taxable income for that year. In other words, it is 100% taxable regardless of what type of investment you hold inside. So for example, let's say you contributed $5,000 into your RSPs and you sold and withdrew the money out when it's worth $10,000. This $10,000 will be 100% taxable, so it will be added onto your total taxable income and get taxed at your highest marginal tax rate. Now that doesn't sound too good, right? You might be wondering, why do people even want to use RSP in the first place then? Well, the key to using RSP effectively is to take advantage of the tax-free growth and withdraw it years later when you're in a lower tax bracket. This way you would have gotten a tax deduction based on a higher tax rate when you're working and only pay tax years later based on a lower tax rate when you have lower income. If you want to learn more about how to make the most use of RSP and the best timing to withdraw, my colleague Jackie has made a detailed video on this, so I'll leave the link in the description below. Number 4 is, what if I sell my investment at a loss? With all the registered accounts, investment loss cannot be claimed on your tax return. So unfortunately, there's no tax breaks here when you lose money. But for TFSA, it gets worse. When you lose money in the TFSA room also shrinks with it. This means you'll have less and less room to grow your investments tax-free. As for non-registered accounts, capital losses are good in the sense that it will provide us with a tax break. But capital loss can only offset capital gains, and it cannot be used to offset taxes that's from your employment income or from other types of income. So if you're in a situation where you have two investments, say investment A is currently up, and you have an investment B that's currently down, and let's say you want to sell investment A to realize the gain, then you could consider intentionally selling the investment B at a loss to trigger the capital loss. So this way you can offset the capital gains tax. The fancy term for this strategy is called tax loss harvesting. So whenever you sell an investment at a gain in your non-registered account, it's a great time to review your existing portfolio to see if you have other holdings that might not be doing as good. And if there's a need to rebalance your portfolio, then this might be a good time to intentionally sell an investment just to trigger the capital loss. One thing I want to stress here is losing money is never going to get you more ahead. So don't try to lose money on purpose. The tax break you get from a capital loss just makes it hurt a bit less, but it's not going to give you more tax savings compared to the money you've lost. Number 5 is, what do I need to report on my tax return? Personal taxes in Canada are based off of the calendar year, so it's January 1st to December 31st. Since the tax deadline for individuals is April 30th, your investment account will usually provide you with a tax document by the end of March. For RSPs or FHSA, you will only need to report the contributions and any withdrawals you made during the year. If you made a contribution, you should receive a contribution receipt to claim a tax deduction on your tax return. And if you've made a withdrawal, even if it's via the home buyer's plan or a lifelong learning plan, you will receive a T4 RSP slip to report on your tax return. And for TFSA, again, it's a tax-free account, so nothing needs to be reported here. And for non-registered accounts, you will receive a T3 or T5 tax form if you sold any investments or received any dividends or income during the year. But if you bought and sold individual stocks, then you should receive a T5008, which is a tax summary that lists out all the transactions of when you sold a stock. Not every investment platform provides a tax summary though, so check to see if you should keep a record by yourself. Basically, when it comes to reporting a stock sale, there's 3 amounts you need to keep track of. First is the purchase cost of the investment, or the technical term for it is ACB, or adjusted cost base. Second is how much you sold it for, or the sales proceeds. And third is any transaction or administrative fees that you paid for the purchase or sale of the stock. And for RESPs, you only need to report the withdrawals on your tax return. There's 3 types of withdrawals when it comes to RESP, so depending on which type, the tax treatment is vastly different. And you'll also receive a T4A to report on your tax return. We've gone over the differences between the 3 types of RESP withdrawals in another video. Click here if you want to learn more about how RESP is taxed, as well as many of the often overlooked ways that could help you avoid taxes.